Hello and welcome to Econoday Unplugged on Tuesday, the 8th of June 2021. Mark Pender's stateside and I'm Jeremy Hawkins in London. Well, I don't know about sell in May and go away, but given all the uncertainties still surrounding the economic outlook and what might happen to monetary policy, last week was an unusually quiet period for financial markets. In any event, there's still plenty to talk about in the wake of last Friday's US employment report and ahead of this Thursday's June ECB policy announcement, which promises to be a real test of the central bank's communication skills. And before that, we are leading the pack when it comes to QE tapering. We'll have the Bank of Canada's meeting on Wednesday. So, Mark, let's deal with the US labour market first. What did Friday tell us?
Well, it's also today, too. We had job openings in the JOLTS report for April. And Friday, we had the jobs report for May, and it came in for the second time in a row below expectations. Not as soft as the prior month, but if you average those 2 months together, you're looking at maybe a 350,000 per month or 400,000 per month gain in payrolls. And well, the number we're trying to reach here is 7 million. So the job losses happened at a much more spectacularly fast rate than the recoveries. It does take time to add workers, of course, but we also had the openings today, and those are very interesting. They shot up 5 times in a row, 5 months in a row. Job openings have exceeded Econoday's consensus range, the top estimate. So, and it by over 1 million in the last report at 9, and today's report at 9.3 million. And so on a percentage basis, that's a 12% rise from March. And hirings in April, which is another number or part of the employment report, but in this report it's called hirings, and that was only up 1.1%. So you're getting a lot more openings, way beyond what people are expecting, the acceleration in openings, and then you are in actually the unemployed taking those jobs. Now it does, like I said, it takes time to get the right person to fill the job. Everyone's deciding, but there's a lot of emergency stimulus on the unemployment benefits, including higher unemployment benefits. Those are much of that will begin rolling off next month. So it'll be interesting to see how fast hirings pick up, because that will give an incentive to the unemployed to make a quick decision because they're not getting the checks anymore. So, or as much of the checks their checks will be smaller. So it's a very interesting thing. Okay, go ahead.
As I say, on that basis, in terms of not going to be checks in, what's happening to earnings now?
Well, earnings are kind of scrambled. It's hard to get a read on it. They're flat, which is an improvement, but and that's as lower wage jobs come on, it'll be. It's not really a play right now in the and for monetary policy here in the U.S. because they were so loaded on the low end, and so wages aren't really a wage acceleration isn't a factor right now, and we can pretty well assume that much of these jobs are low wage, so those numbers will be coming down. They were elevated, but they will be coming down as these lower wage jobs are filled.
And does that make it easier then for the Fed to maintain? Well, the bottom line is underlying pressures are not going to do that much.
Yeah, but wages never really played a factor over the last 12 years anyway. They never really did pick up. They never got significantly over 3% for any kind of a spell, which is kind of like the borderline annual rate. And they never really fed into overall inflation. So, for the policymakers to keep this same gauge in the same way that they had been for a generation is, questionable to me. And so I think more importantly for inflation are the supply chain problems that are rising, causing increased prices at the producer level. And also, I know higher demand is also part of that, and that's a big part of why we're getting these supply chain issues, along with all the COVID restrictions. And demand for energy is very high, and you can't just say that, well, let's exclude energy when we look at inflation trends, because energy is a very, very important part of the economy. So I think that's really how much that feeds into consumer prices. And here in the U.S., it really has, in the last couple of months, fed into some very unusually substantial rises in consumer prices. And on a month-to-month basis, of course, that's what I'm talking about. And whether or not that extends through the coming months, I mean, if demand, employers are trying to look for people right now, and if they can't get the people, those are going to be more. There's going to be more issues of supply constraints, and their ability to produce goods and services will be limited at the same time that demand for those goods and services will be rising, which will be an inflationary risk. But you can only, get the workforce back together so fast. I guess this is unprecedented, of course, what we've been through, but it's interesting to see how quickly the labor market will recover from this. And based on Friday's employment report, it's going to take a substantially long time.
I guess it's probably pretty well the same sort of story in Europe. It's interesting, just going back to, you're talking about the supply shortages and constraints on production and so on. And I guess now we're getting to a stage, certainly just from some of the data from my part of the world, which you could almost build up to be worst case scenario for some of these central banks, in the sense that we've got the supply chain disruptions and the shortage of raw materials already, which are clearly making for a sharp increase in pipeline pressures. But we're also seeing, from the likes of the German industrial production numbers this morning, and from what the likes of EFO are saying, that the shortage of production of raw materials and intermediate inputs is actually starting to hit the output side now. So it seems that one of the reasons why we've seen, well, really a sweet bar the March numbers, we've had 3 falls in German industrial production during the course of 2021, monthly falls during the course of 2021 so far. And part of this really does seem to be the fact that producers, particularly in the auto industry, where there's this massive shortage of semiconductor chips, they simply can't get hold of the inputs necessary to produce their output. So in other words, we're talking about rising inflationary pressures, potentially the cause of those rising inflationary pressures dampening output at a time when demand is coming back potentially quite quickly. So you put all that little lot together, you could end up with growth kind of undershooting the recovery expectations just when inflation starts to go up. So if you're a central banker, of course, then you're really sort of facing worst case scenario. So it's going to be really interesting how this pans out.
It's interesting how employment fits in there, and the lack of ability of the employers to ramp up to make that production to fill those gaps is an inflationary issue.
It is. I mean, it's interesting, some of the guys were coming out of Intel, I think, back into last month, they're talking about the shortage from their side, talking about lasting for a couple of years or so. Others, I think, have suggested it perhaps half a year, but it does seem to be the case, at least for the balance of 2021 anyway. There is going to be a scramble to get hold of these inputs. And of course, that again is just fueling the issue, because you've got a lot of purchasing activity we can see from the various purchasing managers' surveys is essentially through the roof. And that's not just a reflection of the fact that demand's picking up. It's a reflection of the fact that these purchasers are concerned that they're not going to be able to get the input and raw materials in the first place, so they're trying to stockpile it now. And again, that's just fueling the underlying problem. So it's a bit of a dislocation, I guess you say, between demand and supply at the moment is such that it really could become a major problem for the policymakers.
We had the small business I know you know it, that we had the small business optimism index, and I was looking back. That has missed Econoday's expectations, consensus range, 8 months in a row. That is incredible. And so however much demand there is, there's a lot of inflation, and there's a lot of inability to get things going, and maybe that's what we're seeing at the small business side as a confirmation. So forecasters are underestimating how fast the job market is recovering, and they're overestimating how optimistic at least small businesses are.
Yeah, I think that's right. And it's interesting just in terms of look at what businesses are expecting. Typically across a big chunk of Europe, we've seen business optimism as per the likes of these PMI surveys at or around record highs. But it's interesting in the EFO survey, the one for Germany, which came out this morning, where we saw expectations on, yes, they are still very strong historically, but nonetheless, the market consensus would see a further improvement coming through in the latest data. And in actual fact, we saw a decline. And again, part of that appears to be to do with the fact that producers are struggling to get hold of the inputs they need to actually, to make the output in the first place. So perhaps we'll start to see some of these optimism numbers begin to come off a little bit.
Well, that's interesting because these optimism numbers, these are based on surveys, or consumer surveys or business surveys. But we had factory orders U.S. factory orders last week. I can't. I can call that up in a second here on the Econoday calendar. Go back to last week. But what was striking about it was how flat. Actually, I think it might have been in a decline. See, it came out at Friday at 10, and this number, and this is a shock. This number came in at minus 0.6%. This is factory orders for April. This is the definitive number for the factory. Well, there's a couple. There's production as well, but these are new orders, and that was well below the Econoday consensus, which was for a 0.1 gain. But even the gain is so small. And this is in comparison to the Philly Fed or the ISM manufacturing or the market manufacturing PMI. These are all through the roof at record showing. So and now these companies, that's different than the small business optimism index, which is concentrated on small businesses. Business surveys, they try to break it, make their panel representative of the economy, but they're including large companies as well. So maybe these large companies are seeing greater amount of acceleration than the smaller companies. I'm not sure. But in any case, we were talking before about the separation we're seeing between the business surveys, which are sky high, and the definitive data as it grinds in at a slower pace, and it's not living up to these expectations.
Yeah, I must say it's going to be interesting, I think, to see how this second quarter and the second half year recovery pans out, given the way it's been talked up for so long. Okay, thanks for that. I guess from my side, then, I suppose the key this week is going to be what the ECB decides to do on Thursday. As I mentioned in the intro, it could well come down to how they want to communicate whatever they're going to do, should they decide to do something. So a bit of background then, just quickly. Folks may remember that going back to the March meeting, the ECB announced that because we had this sharp run up at that stage in bond yields, which the ECB certainly didn't want to see because it's still concerned about the outlook for the economy and the fact that inflation was so low, they announced that they would be stepping up their main QE weapon, which is the PEP, the Pandemic Emergency Purchase Program. They'd increase it by a significant amount. Now, from what we've seen from the weekly purchase numbers, it seems that the asset purchases were increased from what was previously around about 60 billion euro a month to about 80 billion euros a month. Now, as we talked about in the past, within the ECB, there's certainly some clear splits at the moment amongst the council members as to whether or not policy they should start to think about tightening policy, or whether it should be continue to be very soft or indeed even loosened. But it does seem that in order to get through that increase in net asset purchases back in March time, they had to agree that it would only be temporary and would only last for the second quarter. So that brings us up to where we're going to stand on Thursday, because this will be the last ECB policy meeting before we move into the next quarter. So strictly speaking, if they're going to adhere to what they indicated back in March, we should see the ECB come out and announce that, okay, we've had this period of a significant increase in asset purchases. We're now going to unwind that and take it back by 20 billion euros and reduce it down to the 60 billion that we had in place before the increase came through. Will they actually do that? Well, this is going to be an interesting one because what did they do? Well, we know they increased these purchases because they were worried about particularly what was going in the bond market and the concerns about the potential for deteriorating financial conditions, as they call it. Well, as we look where we stand at the moment, yes, it's true that over the course of the last several weeks, we've seen bond yields right across the Eurozone coming down, but they are still significantly higher than they were at the time of the March meeting. And we're looking at spreads between the peripheral countries, the likes of Italy and Spain versus Germany. Well, those spreads are still relatively wide and certainly a good deal wider than they were back in March. So does that mean then that the ECB will decide not to taper? Or might they taper only slightly? Or might they actually leave things where they are at the moment?
Now you're talking about on Thursday, next Thursday, on this Thursday.
This Thursday, yeah. What they're going to do is this Thursday, because this is their last.
So you see a possibility that they could announce some kind of a tapering?
Well, strictly speaking, if they were to come out and announce, right, we are now taking we're going to reduce our monthly pet purchases by $20 billion a month. And they won't actually say it specifically as that. But all they'll be doing is just going back to what they said they would do in March when announced this increase would be only temporary.
But
however,
it might not read that way.
Well, this is it. The problem for the ECB, and particularly because there's all this concern about who's going to be tapering next, and of course, tapering is the first step towards ultimate interest rates going up, etc., etc., etc. And the problem for the ECB as well is that this euro is far too high. And as we speak, euro dollar's trading at about 122. Now, it's clear from when the ECB's made verbal statements in the past, they really don't want to see it much above this sort of 1.20 level. So it's harder than it was at the time of the March meeting. We still got bond yields too high. We still got spreads too wide. The currency's too strong. What happens then if they come out and let's say, well, they're not prepared to risk fully unwinding the March increase, we'll just do half of it, say, and reduce monthly pet purchases by 10 billion a month, so take it down to 70 billion a month. Would that be enough for the markets to start, this is the start of the tapering process, people start, yields back up, people start buying euros again, do they risk it? So I think if they're going to sorry, just to finish that, say, if they are going to taper, it's going to be hugely important how they sell it.
Well, that's right.
Communication is going to be key.
So if for our investor listeners, if you were a playful or a mischievous, perhaps a headline writer, and you're covering this, how could you get the most spectacular reaction out of something that a technical adjustment is what it sounds like, right? So, I mean, how could that be exaggerated at first glance by the press? Now, I'm not really talking about the ECB, how they try to state it, but how the press would state it to the investment community.
Well, I suggest, the press will come in, ECB has started the tapering process, full stop. And if you said it like that, then, if you don't really know fully what's going on, the start of the tapering process would be the first step towards ultimately ending QE and then paving the way for higher interest rates.
And then the euro would shoot up?
And I think, well, certainly, the possibility, will it shoot up or not, but it's could well be, lead to an increase in the euro. So I think, for the ECB, what they have to do is to, a bit like the Bank of England did their last meeting, when they decided to reduce their asset purchases. The ECB needs to stress that, right, the PEP stands at, the amount originally available under the PEP for net asset purchase was 1.85 trillion euro. The amount still stands at 1.85 trillion euro. All we're doing is just altering the pace at which we potentially get there, which is exactly what the Bank of England did when they made their technical adjustment last month. So in other words, you can sell that as being this has no real implications for the monetary policy stance. And they've got to really sell it that way just to make sure markets don't get, as you were saying, start panicking about tightening and taking the euro even still higher.
Well, it'd be interesting to see how they express it and how you express it in the Econoday platform here.
You're right. No, I said you're right, because if you think about it, when we go back to March, they didn't give a number, which is no great surprise, I must say. All they came out and said, as near as I can remember it, they would be increasing asset purchases under the PEP significantly higher than we saw, during the first quarter of the year. Now that left markets at this time thinking, well, right, okay, what does significant mean? At that stage, we had monthly asset purchases of 60 billion. So a significant increase. What's that going to be? 10 billion, 20 billion, 40 billion, even up to 100 billion asset purchase a month. So we now know that significant meant an increase of 20 billion. They may just come out and say we will be reducing, and then what kind of adjective do they use? We'll be reducing marginally, we're reducing significantly, whatever it may be. So I say the wording of what they say could well have major implications for the financial markets. Right, that's probably enough on the ECB. Should also mention the Bank of Canada, which, as we talked about in the past, have been one of the more aggressive amongst the central banks actually doing the tapering. We saw them move, a couple of months or so ago when they reduced, back in April, when they reduced their monthly, the weekly asset purchases by $1 billion or so. That was down to 3 billion Canadian dollars. There has been some talk that they might come out and reduce by another billion as soon as Wednesday's meeting. In practice, I think that looks kind of unlikely. And I think the real reason for that is that the bank seems to be going down the route that they don't want to do anything too aggressively too soon. So they're really looking at phasing in this tapering in such a way that they can leave financial markets essentially as little impacted as possible. Also, of course, they've just been faced with some, I guess, certainly by their standards, some relatively weak economic numbers. So we had the May employment report out at the same time as the US report last week, and that showed a decline in employment of 68,000. Now that was on top of a decline of over 200,000 in April. So we got back-to-back declines there, which kind of makes you wonder, what's going on with GDP. Now, the stats guys, their flash forecast for GDP in April was minus 0.8%, which I guess is no surprise when you've got employment down over 200,000. And taken at face value, with the May data, another decline of almost 70,000. We saw no change in the work week. So, in terms of taken at face value, it kind of suggests that we could even see a negative number for May as well.
Well, we had Canadian merchandise trade, which you did this morning. Now, that's interesting because imports declined substantially, I guess, compared to exports, which is good for the GDP number. But I see a 4.7% month-on-month decline in imports. That doesn't say a lot for demand right now, domestic demand in Canada.
Yeah, that's right, and it's key to pick that out. I think there's a couple of aspects of this really, with amazingly enough, relevant to what we've been talking about. From the import side, as you mentioned, was a significant decline coming through there. There was also, although not as big, a decline on the export side as well. Now, both sides of the balance sheet have been hit by the this supply shortage thing, particularly regarding semiconductors. So, in terms of looking at the the auto vehicles and parts, they fell out of bed again in terms of the April data. They're down over 18% on the month.
That's exports?
That's exports of motor vehicles and parts. And that was not so much due to the weakness of overseas demand. It was due to a real shortage of these semiconductor chips, which meant there was a variety of plants which actually simply had to shut down output. So there wasn't the output there to actually be able to export in the first place. Now, from the import side, you're right, there was a bigger fall there. We had total exports down 1% on a month, imports were down almost 5%. Well, that was a reflection of tighter COVID restrictions which were introduced in April time. And that's why we had this excellent growth out of Canada in the first quarter, which really surprised a lot of people against original expectations. But they were slow in kind of the COVID profile. So the rises we saw coming out of the States, certainly out of Europe, came through in COVID cases a month or so before we saw Canada going down the same path. So we're kind of seeing Canada lag behind what's happening elsewhere. And it does seem that at least potentially some of the strength we saw in growth in Canada in the first quarter will be at the expense of what we're going to see in the second quarter. And I think from the central bank's point of view, although it looks as if the underlying picture still seems to be pretty favourable, and the COVID cases have certainly come down sharply over the course of the last weeks or so, they're going to need a bit of confirmation that what will probably be a weak second quarter is just an adjustment to the first quarter and COVID, and the second half of the year is going to be good. So Yeah, given all that, I don't see any real pressure on the Bank of Canada to come out and do anything as far as this week's concerned.
Let's talk about Friday in the UK data. You have industrial production, trade, and monthly GDP. UK, like the US, is coming out of the pandemic, and UK has consistently dwarfed the expectations of forecasters most of the year, and including over the last 6 weeks or so. How do you see those numbers playing out? What I mean, if if the UK, are they going to offer some kind of a model or presaging what other European economies are going to be doing?
I think, well, the answer to that, I think, is a lot of other European countries will be hoping so. I mean, as you mentioned, the UK economy has been recovering, it appears anyway, because we still don't have a lot of hard data at the moment. Most of it tends to be surveys. But what we do have suggests that second quarter GDP for the UK is going to be very strong. And of course, it's because it's been leading the way in terms of the vaccine rollout. So the COVID numbers over here have been excellent. Now, as far as Friday is concerned, these will be numbers for April when we had some of the reopening going through. We expect, it looks as if from the Conde consensus, we're going to see an increase in month-on-month increase in GDP about 2.4% or so. That would be a second month of growth of over 2%, and really, consistent with the idea that the second quarter.
That's monthly growth. What's on an annual basis? What, 12, 15%, something in like that, right?
The annual number will be, off the top of my head, I can't remember, but it'll be through the roof because of obviously we've got the the problem with last year. But if you start annualizing the 2.4%, then yes, you're talking getting on towards 26% or so. So
it's been accelerating faster than economists have expected.
It has, that's right. And I think it is largely because the vaccination rollout has been faster than expected, and it's meant that the easing of the lockdown, if anything, has come through a bit quicker than expected. Now, of course, there's always a problem in these things, and in this case, it's what we used to call the Indian variant of the COVID, which now apparently, according to who we're supposed to call the Delta variant. That is climbing alarmingly in the UK now. It's by far and away the principal virus problem affecting the UK. And if you believe what our guys are saying, the scientists, they reckon it's about 40% more transmissible than the old Kent, or what is now called the Alpha variant, which is one of the first mutations which came out of the UK back towards the back end of last year. So it looks as if, well, it would appear to be, from what the politicians are saying, it's 50-50 as to whether or not this June the 21st date, which is supposed to be when we have the complete reopening of the UK economy, comes about or not. There's a lot of speculation it'll be delayed at least 2 weeks, perhaps even a month. We'll still have to wait and see at the moment. Of course, if that were to happen, then some of the expected strength coming through in June and July simply won't be there, because we won't be as open an economy as people expected it originally. So
what are the scientists saying in the UK about vaccinations against the Delta? Are they working?
Well, the good news is at the moment, I mean, from what they're saying, all the evidence appears to be that although this variant is 40% more transmissible, the current crop of vaccines still appear to be working against it. The concern, I think, is that because it's so much more transmissible, it's more people are getting it more quickly.
And that's the unvaccinated.
Yeah, that's right. Yeah.
What's the percentage in the UK of people who've been fully vaccinated?
Fully vaccinated, I think so. With 2 doses, I think we're probably running at around about 40%, something like that now.
Has that been tapering?
It's slowed a little bit because there's ongoing wars about who's going to get the vaccine and who hasn't. But it hasn't slowed much, and certainly I think in terms of just with regards to single doses, they're up around 70% or so, perhaps a bit more than that. In fact, of the adult population, it really is a very high number indeed now.
Are vaccinations being limited by the supply availability of vaccinations in the UK, or by demand that people there's a significant portion of people who do not want to be vaccinated?
I think it's fair to say that the UK stockpiled a sufficient supply that, by and large, even though they lost some of their would-be imports of vaccines, not so much coming out of Europe, but coming out of India, who decided, when their cases went through the roof, that they put a clamp down on all vaccine exports. Some of those were due to come to the UK. Then I think hit the UK a little bit, but by and large, as I say, I think the stockpiles were so high over here that the vaccination program continues to roll out at basically what the government was planning. And so, yeah.
But I'm raising the indelicate question of whether or not the unvaccinated people who do not want to be vaccinated are going to slow the recovery, slow the
Yeah, well, that's the risk, and that as well. And the government spends half its time on its press meetings, just emphasising how important it is that everyone, unless for some medical reason why they can't have it, gets vaccinated. Because until that happens, the virus is going to continue to move about. It's going to, some point, presumably, mutate again, and as we talked before, the risk is that you come out with some kind of variant which the current crop of vaccines simply can't deal with. So yes, the government is looking to try and get the entire population vaccinated. I think almost by the end of this year, if not sooner, if they can do it. But there's always going to be some people who don't want to have it. Okay, as ever, we've probably been talking on for too long. Anything else from your part of the world you fancy putting in before we wind it all up?
Let me just look here at the calendar one last time for what we see ahead. Well, I mean, it'll be coming up. We get on, we're going to get the CPI on the U.S. CPI on Thursday, and and that's going to be a big report because this will be the first definitive numbers on May for the U.S.
What's expected on that?
Well, these are giant, 0.4% for both the overall and the 0.4% monthly gain for that. The core, excluding food and energy, is the Econoday's consensus, with the outside high end at 0.6. These are big readings. This number is usually 0.1, 0.2,
so if you start annualizing these numbers over the last 3 months or so.
Right. That's 5. Yeah. What is that? That's 5% or something like that, right? And that would follow on top of a 0.9% rise for the core monthly core in April. So if there is an upward surprise on that, that would be pretty upsetting. And then on Friday, we get a major reading on inflation expectations from the Consumer Sentiment Report from the University of Michigan. And this has been going through the roof in their numbers. I don't have that right here, but it's it's like a survey record high or near a survey record high going straight up, and business inflation expectations haven't been going straight up, but they're at records, and that's tracked by the Atlanta Fed. That number doesn't come out this week, but that has also been moving higher in its own way, even though it's a slower process with that reading. But these are all very high indications for inflation. And has the UK seen anything like this?
Well, looking at some of the survey evidence as far as inflation expectations are concerned, the manufacturing side of it is at an all-time record. Services inflation expectations, they've increased from the top of my head, I think, in each of the last 5 months, and they're now back to where they were January before the COVID crisis. Household inflation expectations are also been moving up. I think they've increased over the last 4 months or so, but they're still below where they were before COVID actually first arrived. So it's a bit of a mixed picture, but you lump it all together, inflation expectations are certainly moving up, but not as quickly as they are on your side of the pond at the moment.
Well, I see on the 16th, we're going to get UK. I'm looking at the calendar here, UK CPI. And it rose 0.6, I guess, in April on the month. Is that, for the U.S., the CPI is not the definitive number. It's the PCE, which comes out a month end. It's the Fed, and they're taking adjusting the data in a more thorough way, in a more a timely way. So, and that's the number they use. Is the CPI the main gauge for the BOE or is there something else that we should look at in the UK?
Really, it's a consumer price index. it's the one that's actually in their remit. That's the measure of inflation they have to target. So the medium-term target of 2%, effectively plus or minus 1%, or the Bank of England governor has to write an explanatory letter to the Chancellor of the Exchequer. So yes, it is a consumer price index, but it's worthwhile, remembering when you come to the UK, the monthly numbers aren't seasonally adjusted. So you can get a big monthly number, which if you thought stateside, that's horrendous, but because it's not seasonally adjusted, it may or may not mean anything.
That's
So,
interesting. They don't adjust the monthly number?
no, the monthly number is just...
It has to be calendar adjusted for the numbers of days in the month and those things, no?
Well, no, they just have a straight unadjusted raw number.
Wow.
So... But it comes down to, it's used for indexing and it can't be revised and anything like that. So the view is that because it's used in so many formulas, be it in derivatives, be it in benchmarking, pay awards, and so on and so forth, it can't be adjusted. So once you get a UK CPI out, that is it. It won't be adjusted again. It won't be touched again. That is it in perpetuity. So once you get the CPI, you can look at it month on month, and obviously people forecast it month on month, but really just with a view to determine what the what the year-on-year figure is. Now that's a bit problematic at the moment, of course, because of the COVID effects from last year. Although having said which, it doesn't really seem that inflation, well, at least consumer prices in the UK, were particularly impacted by COVID in 2020. Certainly any implications it had there were significantly less than we had on things like industrial production and retail sales.
Still 0.6 looks pretty high there in April. If they get, I'm just looking at the graph here on Econoday's sheets, and it's going up. I mean, it was at minus 2% earlier in the year, and it just steadily risen 0.6. If that extends higher, would that upset the BOE?
Well, the BOE's forecast is it's got to be said. I mean, currently we have inflation, year-on-year inflation in the UK running at 1.5%. Now the core rate is running at 1.3%, so usefully lower. And most of the pickup we've had so far has been due to what's been going on in oil prices. So the Bank of England's own view is that they expect to see headline inflation moving above their 2% target point towards the back end of this year and into next year. But then in true central bank fashion at the moment, like all these other central banks, they adhere to the view that the acceleration inflation will be only temporary due to one-off factors. And so within a year and a half or so, they expect it to move back down round about the 2% mark, which they expect it to hold then over the rest of their sort of 3-year forecast period. So the Bank of England's view, at least as it stands at the moment, and we'll get an update later on this month, of course, with the June meeting, which will certainly be interesting, is that higher inflation currently doesn't warrant any shift in policy. But they have also said they're looking very closely at what's happening too on the supply side at the moment. And of course, given that the pressures there seem to be intensifying, it may be we'll see some proper tapering of QE coming through sooner than currently discounted. Watch this space, as I say. Right. Okay, then. Let us wind it up there then before we do prattle on for too long. So on behalf of Mark and myself, thanks as always for listening. Podcasts will be back next week, and we'll be including an update from Brian Jackson, our Southern Hemisphere expert. So please do join us then. And in the meantime, you can keep up to date with all the key market moving data and events listed and analysed in Econoday's global economic calendar. We'll see you next time. Bye for now.